Hello, hello, hello. Good morning, everyone. Hello. This is a quiz question. Do you remember? Do you remember this quiz question? The right answer for this question is not affecting working capital. So we didn't mention the term working capital, but you can easily find it on Google, right? So what is working capital? So what is working capital? It is the difference between current assets and current liabilities. Okay? So when you use cash to settle, a liability, a payment of current liability. Let's just say you pay $2,000 to settle the salaries payable. All right. So this transaction, when you spend $2,000 to settle the liability, you see there's a reduction of current liability of $2,000, and also there's a reduction of cash, which is a current asset of $2,000. So when these two both reduce by the same amount, the difference between them should remain the same, right? That is why the correct answer is not affect working capital. Is that clear? Is this clear? Anyone want me to explain it again? Right. So when you see there's a new term here, right, working capital, the first thing you need to do is to think about how to solve the problem by yourself, right? So you ask Google, working capital. And Google says working capital is the difference between current assets minus current liabilities. That's the equation here. Working capital equal to current assets minus current liabilities. Okay. So a payment of a current liability means you pay to make this liability go away, right? To eliminate this liability. So when you make payment, that means your cash reduced. Because your liability is reduced, you debit your liability, right? Now I just give an example here for this scenario. A payment of $2,000 of cash to make $2,000 of payable, salaries payable go away. So we debit salaries payable $2,000 and credit cash $2,000. And these transactions impact on working capital is current asset in the form of cash reduced by $2,000. Current liabilities in the form of salaries payable reduced by $2,000. Since this one reduced by 2,000, this one reduced by 2,000, the difference between them should remain unchanged. Is that clear? Yes? Say it again. No, total assets minus total liability equals owner's equity, right? So the name is actually quite self-explanatory. So that's working capital, you make it work, right? The difference between current assets and current liability, that means part of the current asset, you're going to use them to settle the current liabilities, and the rest of them you're going to use to generate profit, right? Accounting students, you'll see this term, working capital, a lot in your subsequent accounting courses, right? Okay. And also for students who are not going to specialize in accounting, you should get a brief idea about working capital. You don't want your working capital to be negative. Does that make sense? If it falls below 0, that means your current assets cannot cover your current liabilities. Okay, so that's a quiz question. Okay. All right, I got some questions about defective inventory expense. This is not new. When we talk about it in TBL, actually in week 3's lecture, we briefly mentioned about why and when do we record defective inventory. That is when the net realizable value drop below the cost of the inventory. So in the lecture, Tony explained this part quite clearly. So hopefully, if you don't understand it, if you don't understand net realizable value, or the difference between net realizable value and costs, please listen to week 3's lecture recording again. Okay? So basically, when the net realizable value drops below the cost, according to the accounting standard, you can't just leave your inventory record alone. You can't just leave it as it is. You need to write down your inventory value because it has lost value, and you need to faithfully represent your accounting records. Need to faithfully represent your inventory value by reducing the original recording. Is that clear? All right. So before we start talking about today's case, I just give you the Lily Down Studio because I think you guys are quite familiar with this case now. So we're going to use Lily Down Studio case to learn cash flow statement. And you can see that cash flow statement in Lily Down Studio is more comprehensive and more complicated than the TBL simple cash flow example. Let's look at the TBL simple cash flow example first. Are you familiar with, do you still remember the indirect method and direct method? Yes? Do you still remember the difference between them? So one is more direct, right? So from the direct method, you can tell where the cash flows out, where cash flows in, right? And also under the direct method, it's over there. Under the direct method, we divide the cash flow into 3 categories. One is operating activities. The next one is cash flow from investing activities. And last one is cash flow from financing activities. And these 3 activities jointly drives the changes in the cash position from year 0 to year 1. Okay. So as you can tell from here, the indirect method and the direct method, they just look at the cash flow from different angles, right? And also the cash flow from operating activities, these two numbers are nicely matched. Okay? They just look at these numbers from different angle, but these two numbers nicely matched. From indirect method and direct method. And from indirect method, you cannot get information about cash flow from investing activities or from financing activities. So these two can only be found in direct method. Okay? So let me just give you a very simple example to see why it is important for business to show shareholders the cash flow statement and why the numbers on cash flow statement is different from income statement from three kinds of business activities. All right. So, for example, let's look at the case in operating activities. For operating activities, let's just say beginning balance of accounts receivable, just say we have $1 million. And this year we made sales of $9 million. Okay? And at the end of the year, we find we have an ending balance of $2 million. So this piece of information tells you how much changes in cash. How much is that? At the beginning of the year, we have accounts receivable of $1 million. And this year, we made another $9 million of sales. That means we are entitled to collect $10 million from our customers. Is that clear? Yes? At the end of this year, we find that we are still entitled to collect $2 million from our clients, from our customers, which means we've already collected 8 million, right? So this operating activity leads to an increase in cash of $8 million. But what's the influence of this transaction on income statement? Our income statement. Just sales increased by 9 million, right? Okay, next one, investing activities. When we purchase a machine, which is worth $5 million, and we paid cash, $5 million. This transaction leads to a decrease in cash of $5 million. Do you agree? So what's the influence of this transaction on income statement? Depreciation, right? At year end, there will be depreciation expense. So let's just say the depreciation expense is 0.5. $0.5 million, so that's an expense, right? That's investing activities. And you see that the business activities actually drives cash and the profit changes differently. Okay, financing activities. Let's raise cash fund from shareholders, 2 million. What do we credit here? Share capital. What's the influence on income statement? What's the influence on income statement? What about dividend? Does dividend influence income statement? No, it influences changes in owner's equity, right? So even this business pays dividend, it has no influence on the business income statement. Okay. So this leads to an increase in cash of $2 million, and this has nothing changed. So the net effect of changes in cash, in this case, is $5 million. Increase $5 million. And all the business transactions influence on income statement is 8.5. All right. Which in turn means from the face of income statement, you have no clue about how cash changes over the year. Okay? And that is why we need to prepare cash flow statement and to present financial report users how cash is used, how cash is generated from 3 different perspectives. Is that clear? Yes? All right. Okay, that's the reason why we need to present cash flow statement. So before we jump into the direct method, I would like you guys to look at indirect method first, because I've posted a YouTube video on Canvas. Did you watch it? Did you watch it? Very hurtful, eh? You should watch it before you come to the class. So you'll find this. Let's watch it together, because I made this one. Okay. All right. Hi everyone. I'm going to explain the basic idea about the indirect method for the preparation of the statement of cash flows, also known as reconciliation of net profit after tax with cash flow from operating activities. First, let's look at the reconciliation of operating cash flows from 2013's warehouse's financial statement. Under the accrual accounting system, we know that firm's net profit is not necessarily equal to the net cash flows from operating activities. So this financial statement under the indirect method, the reconciliation of operating cash flows, explains the relationship between net profit and net cash flow from operating activities. Basically, we start from net profit. We take into account the non-cash items classified as investing or financing activities, and changes in assets and liabilities, we get net cash flows from operating activities. So from this net profit, after we add some numbers and subtract some numbers, and eventually we get the net cash flow from operating activities. For example, from the net profit, we subtract the increase in trade and other receivables. So in this video, I'm going to explain how are we going to prepare reconciliation of operating cash flows, the indirect method, and we are going to explain why do we subtract some numbers and why do we add some numbers to the net profit. Just have another look at the reconciliation of operating cash flows. We notice that depreciation and amortization expense is categorized under non-cash items. So amortization, in my course, we don't really cover it. We apply depreciation to fixed assets like property, plants, and equipment, the PPE, but amortization is applied to intangible asset, which is not the focus of my course, but it applies, for example, to patents, okay, patents or license. So such intangible asset, you apply amortization, which is quite similar to depreciation, but you don't need to worry about it in my course. Okay? So in my course, just focus on depreciation. Gain on sale of property, plant, and equipment, so that's gain on sale of PPE or loss on sale of PPE, is classified as investing or financing activity. Loss on sale of PPE can also be categorized under non-cash items. Now let's look at, this is a bit quick. So when you look at gain on sales of PPE, it categorized under investing or financing activities. When you see loss on sale, you can either categorize it under investing or finance activities, or you can also categorize it under non-cash items, loss on sale of PPE. Classified as investing or financing activities. Loss on sale of PPE can also be categorized under non-cash items. Now let's look at the basic idea behind the reconciliation of net profit after tax with cash flow from operating activities. So we need to find out the relationship between net cash flows from operating activities and net profit. Let's start from the very basic idea here. We understand that incomes minus all the expenses equal to net profit. There are multiple ways to increase incomes, and also there are multiple ways to increase expenses. Let's just look at some commonly used items in textbook or in the very first accounting course. So for example, when cash increase, it's likely that a business makes some revenues or makes some incomes. For example, when a business made rent revenue, we can debit cash, or if we haven't received cash yet, we debit accounts receivables. Debit cash in this case, or accounts receivable, 100, and credit rent revenue. So rent revenue increased by 100 will also lead to the increase in cash or the increase in accounts receivables. Another way to increase income is by making some gains. So for example, we have a car that cost $10,000 historically. After we use it for 4 years, the accumulated depreciation is $4,000. That makes the carrying amount $6,000. Then we sold it for $7,000. That means we actually made a gain of $1,000. So these parts we've explained it in week 3's tutorial. Do you remember? When we dispose fixed asset. So if the sales price, so after this is the original price of the car, original cost of the car, $10,000. After, let's just say we used it for 4 years, the accumulated depreciation is $4,000, which means the carrying amount of the car is $6,000. Ideally, or theoretically, we should sell this car for $6,000, right? We should, because according to the records, it has a value of $6,000, so we should sell it for $6,000. But for some reason, our car is quite popular. We sold it for $7,000. That means we sold it more than the accounting records. That's why we say we have a gain of $1,000. Is that clear? Likewise, if we sold it less than $6,000, let's just say if we sold it for $5,000, that means we sold less than we expected. Is that clear? So when we sold less than we expected, then the accounting records, we record a loss on sale. Okay? And this gain on sale, guys, this gain on sale, do we include it in income statement or comprehensive income statement? This is an actual business transaction. We've done it. And we realize the gain. We get solid cash. Okay? So the money has been earned. Okay? The gain has been realized. So this gain on sale should be included in income statement. Is that clear? So what about the revaluation? So revaluation of a piece of land, let's just say if this piece of land increased in value by $1 million this year, but we haven't sold it yet. We still keep it. That income is comprehensive income. Okay? Because we haven't realized it. We haven't sold it yet. So that income, we categorize it as comprehensive income. It is not as, well, let's just say the earnings quality is not as high as gain on sale. Because this one, we have actually sold it, we gain it, we realize it. All right? So this gain on sale of the car should be included in income statement. Revaluation, comprehensive income statement. So where do you list the gain on sale? So if this business has gross profit, what you need to do is first line net sales. So that is equal to gross sales minus discounts given to customer, okay, and return of sales, minus cost of goods sold, and you got gross profit. And below gross profit, you can chuck in other income. So that could be gain on sale. Okay. And below, you list all other expenses. Okay. Okay, let's carry on with our cash flow statement. Okay, so we're talking about gain also increase our incomes. Okay. Here is the journal entry. So we made a gain of $1,000 in this case, and gain increase our income. Unearned revenue, if we made some revenue from unearned revenue, that will increase our income. For example, we reduce our unearned revenue by fulfill our obligation, by provide service, or by providing goods. So in this case, we debit unearned revenue, for example, $200, and credit revenue for $200 as well. So the decrease in our liability in unearned revenue also can be attributable to the increase in our revenue. Expenses, likewise, when expenses incurred, for example, salaries expenses incurred, we credit cash or we credit salaries payable. That means cash reduced and salaries payable increased. Depreciation is also a type of expense. Loss is also a type of expense, and I also give an example about loss making. For example, similar scenario here, the carrying amount of a car is still $6,000, but we only sold it for $3,000. That means we made a loss of $3,000. Prepayment. So if we have already prepaid rent for, let's just say, $1,000, after we stay in this property for like a month, we consume part of the prepaid rent. So we need to recognize the increase in rent expense and credit and recognize the decrease in prepaid rent. So the decrease in prepayment also shows that there's expenses incurred. Okay? So incomes minus expenses equal to net profit. Next step is we can substitute these items and these items into this magical equation. Let's hide these for now. So we see that after we substitute these items into this equation to replace incomes, and we substitute these items into the equation to replace expenses, the equation looks like this. The increase in cash plus the increase in accounts receivable plus gain plus the decrease in unearned revenue minus the decrease in cash plus the increase in accounts payable plus depreciation plus loss plus the decrease in prepayment equals net profit. Basically what I'm doing here is to expand the equation we talked about on Friday. Remember? On Friday, we only involves cash, accounts receivables, and accounts payables. Now we expand this equation by incorporating more scenarios. Okay? So we substitute more items into this basic equation. Is that clear? So that's what I'm doing here. And the purpose of me doing this is to establish the relationship between cash and net profit. It is because the reconciliation is to explain the relationship between net profit after tax and net cash from operating activities. That is why I'm doing this, to establish the relationship between these two items. Is that clear? Yes? After we open the bracket, we combine the cash items. So we have a changes in cash plus these 4 items and minus these 4 items equal to net profit. So up to now, it's purely mathematical. Now we shift. Is everything clear so far? Yes, student at the back? Do you understand what I'm doing here? Any questions? Any questions? Hello, questions? Shift these items to this side, to the net profit side. Then we get the changes in cash equal to net profit plus prepayment plus loss plus depreciation plus the increase in accounts payable minus the decrease in unearned revenue and minus the increase in accounts receivable. So now we establish the relationship between net profit and changes in cash. So as we can see, the first thing we take care is non-cash items, depreciation and loss. Second step, we look after items classified as investing and financing activities. Here it could be loss, it could be gain. Next, we look after the changes in assets and liabilities. So from this equation, we see that we need to subtract or minus the increase in asset plus the decrease in assets plus the increase in liabilities and minus the decrease in liabilities. In this way, purely mathematical, we establish the relationship between net profit and net cash flow from operating activities. So when we refer to the warehouse's reconciliation for operating cash flow, we see that starting from net profit, warehouse also look after net cash items, for example, depreciation first, and then look after items classified as investing or financing activities, for example, gains on sale of PPE, and then changes in assets and liabilities, for example, trade and other receivables, inventory, and trade and other payables. And this is a very nice little summary here. So up to now, my explanation so far only focused on the purely mathematical manipulation here. Now I'm going to explain this part from accounting perspective. That is why we need to subtract the increase in assets from net profit to get cash, why we need to add the decrease in asset to get cash, why we need to plus the increase in liabilities, why we need to subtract the decrease in liabilities from the net profit to get cash. Now let's look at the relationship here by looking at these simple examples. Let's suppose your business starts with a cash balance of 0, and this relationship still holds. That's revenue minus expenses equal to net profit. So when you start your business with a cash balance of 0, that means you have 0 cash and also 0 net profit. Now, after providing service of $200, you haven't received cash yet, you record it under accounts receivable. The journal entry is debit accounts receivable $200 and credit revenue $200. This transaction has no impact on cash, but it affects net profit. It increased net profit by $200 because of the revenue generated. Now, to make both sides equal, so do you understand what I mean? Yes? So when you provide a service, you already generate a revenue of $200. Suppose there's no expense incurred, this $200 revenue will increase your net profit by $200. Is that clear? But now your cash balance is still 0, right? To establish this relationship, the relationship between cash and net profit, your cash is still 0, but now your net profit is 200. To make both sides equal, you need to minus $200 on the net profit side, which is actually the increase in accounts receivable. Is that clear? That's why I ask you to watch YouTube video before you come to class, right? You need to listen to me, right? Sometimes I feel you are like my daughter. My daughter is 7 years old. She doesn't really listen to me.
we need to subtract $200 from this side. That is actually the increase in accounts receivable, which is an asset item. So this explained why we need to subtract the increase in asset from net profit. Now let's look at what if the customer paid us $100. After we received the $100 from the customer, we recognize that cash increased by $100, but this transaction has no impact on net profit.
Because both items are balance sheet items, right? Cash and accounts receivables. So this transaction does not influence revenue, does not influence expenses. So consequently, it doesn't affect profit. Is that clear? Is that clear? So this transaction only increase our cash by $100. Only increase cash by $100. And this side, when this side increased by 100, but this side, the net profit remains unchanged. To make both sides equal, you need to add $100 on the net profit side. Is that clear? Yes? Right.
This side increased by $100. That means we need to plus $100 on this side to make both sides equal. And this $100 is the reduction in accounts receivable, which is an asset item. Another example is, what if we prepaid rent? After we prepaid rent, our cash reduced by $100. When this side reduced by $100, to make both sides equal, we need to reduce this side by $100 as well.
So this transaction, again, these two items are balance sheet items. So this transaction has no influence on income statement. Does that make sense? Does that make sense? Hey. Yes. So when paid rent increased by $100, it is because we paid cash to build the prepaid rent asset, right? So when cash reduced by $100, and this transaction does not influence revenue, does not influence expenses, does not influence net profit. When cash reduced by 100, net profit remains unchanged. To make both sides equal, we need to minus $100 on this side as well, which is the increase in one of the asset items. That explains the changes in cash. Is that clear?
And this $100 is the increase in asset. Now, if we look at inventory, this is the same logic. When inventory increased by $200, we recognize that cash reduced by $200. So when cash side reduced by $200, to make both sides equal, we need to subtract $200 from net profit side as well. And this $200 is the increase in assets. That is our inventory. Now let's get back to the rent. Let's just say after 1 week, your prepaid rent has been consumed by $50. So we need to recognize the rent expense of $50. At the same time, we credit prepaid rent to recognize the reduction in our asset. These transactions affect net profit side because rent expense incurred. When rent expense incurred, our net profit reduced by $50.
So when this $50 reduced net profit, does this transaction affect cash? Does this transaction affect cash? So the cash remains unchanged, but net profit reduced by 50. To make both sides equal, we need to add this $50 on the net profit side. Is that clear? So this YouTube link is on Canvas. I hope you guys can take some time to go through it after this lecture, right? Preferably, you should go through it before the lecture. But now we don't really have that option now, right? So go through it after lecture. Will you do that before Friday? Will you do that before Friday's TBL? Yes. Thanks.
When this side reduced by $50, we need to add $50 here to make both sides equal, because this transaction has no impact on our cash. And this $50 is the reduction in prepaid rent in asset. Now, let's look at liabilities. Let's just say you hired someone to do some job for you, and you need to pay him $20, but you haven't paid him yet. That transaction can be recorded as debit salaries expense $20 and credit salaries payable $20. These transactions reduce net profit by $20 because of the increase in expense. However, this transaction has no impact on cash. When this side reduced by 20, this side remained unchanged. To make both sides equal, we need to add $20 at the net profit side. This $20 is the increase in liabilities. That is salaries payable in this case. Let's just say in a week, you paid $20 to your employee, to this person, to reduce your own liabilities. So we debit salaries payable by $20 at the same time to recognize cash outflow of $20. So cash reduced by $20. However, this transaction has no impact on net profit because there's no revenue item, no expense item. To make both sides equal, we need to minus $20 from net profit side. And this $20 is the decrease in liabilities. So this little example here explained the relationship shown here. Now, at the end of this video, let's just have another look at the summary here. So, to establish the relationship between net profit and cash generated by operating activities, we start from net profit. We first take into account the non-cash items, for example, depreciation and loss. And then we take care of items classified as investing and financing activities, for example, gain. And then we look at changes in assets and liabilities. Specifically, we need to subtract the increase in assets, add the decrease in assets, add the increase in liabilities, and subtract the decrease in liabilities from net profit to calculate net cash flow from operating activities. Thanks, everyone.
So this is the summary. Oh, we finished, right? So this is a summary of the reconciliation. You can actually see in the Lily Down Studio case, this is exactly the steps we're going to follow. This is exactly the steps we're going to follow to prepare the reconciliation. Okay. So can you please use the relationship we just talked about to complete the reconciliation here? So you start from net profit after tax. Where do you get this number from? Net profit after tax? Where do you get this number from? Income statement. When you watch this YouTube link, please don't press the dislike. No matter how much you dislike it. Okay. Otherwise, I will make the final test question really hard. Yes. Oh, yeah. So the increase and decrease, guys, this is actually comparison between last year and this year, right? So the increase or decrease, you see, yes, the balance sheet. You see how the balance sheet items change from 2013 to 2014. So that's the increase. That's what increase and decrease means. All right. All right. So, guys, here's the answer, and don't copy it down because the answer will be on canvas. What I want you to do now is try to understand it. And the reason I made this video is to help you understand not just from this mathematic calculation perspective. I want you to understand why we need to take care of changes in assets and liabilities in this way from the accounting perspective. So see that when I explain how we deal with changes in assets and liabilities, I use journal entries, right? So I want you to understand why we need to minus the increase in assets, why we need to plus the increase in liability, etc. I want you to understand it from accounting perspective, okay? So now let's look at this case. We start from net profit after tax, and obviously this number is from income statement, the bottom line, right? Net profit after tax. The second step, what we need to do is to look after the non-cash items. Depreciation, which does not involve cash. Loss, when you make a loss on sale, basically you didn't receive the money, the amount of money that you should have received, right? So that's non-cash items. The first one is depreciation. Where do we find this item? Where do we find this item? Income statement, which is an expense. Loss on sale. Loss on sale, where do you find it? Income statement, it's an expense, right? It's an expense. It's here. Here. This is where we find it, all under 2014, because we're preparing 2014's cash flow statement. All right, and we take care of these two, sum it up, that's 4,200. Because we don't have anything else that classified as investing and financing activities, we move on to changes in assets and liabilities. So here, any changes in accounts receivable? Any changes in accounts receivable? How do we find the changes? So look at here, right? Do we have an increase or decrease in accounts receivable? We have an increase. So when asset increase, we subtract the increased amount from net profit. So when there's an increase, this is a minus. Is that clear? Next one, prepaid rent. Do we have an increase or decrease there? We have a decrease. We have decrease. How do we take care of it? When we have a decrease, we plus it, $5,000, right? Accounts payable, where do we find the change? Current liabilities. Good job, right? So there's an increase in accounts payable. So when liabilities increase, 960, we add 960 to net profit. Does that make sense? All right. Next one, unearned revenue. Do we have an increase or decrease? Decrease. When we have a decrease in liabilities, we need to minus. See that? $500. Okay. Next, income tax payable. Income tax payable, we have an increase in liabilities. What does that mean? There's an increase in liabilities, we add that to our net profit, right? Well, intuitively, it should be easy to understand. So when you owe people more money, that means you are holding other people's money, right? When you hold other people's money, your cash position increased. Your cash amount increased. So when your liabilities increase, that increase our cash. Does that make sense? And likewise, when your asset decrease, so for example, this is increase. So for example, your accounts receivable decrease. What does that mean? When your accounts receivable decrease, what does it mean? You collected the cash, right? So when your asset decrease, this increase your cash position. Does that make sense? Yes? All right, let's continue. Increase in income tax payable, increase or decrease? This is an increase in liability, right? Because that means you're holding other people's cash. Next one, wages payable. Do we have an increase or decrease? We have an increase. That means your employee's money, your employee's money currently still sits in your bank account. Other people's money, you still hold them, right? That increases your cash position. So when there's an increase in liabilities, it increases your cash position. This is net effect, all right? And eventually, when you sum up these three items, you get net cash from operating activities. Is that clear? All right. Excuse me. So that's the indirect method. Well, next thing we are going to do is to look at direct method. So as I explained at the very beginning of this lecture, these two methods just looking at, in terms of net cash from operating activities, they just look at things from different angles, right? This is a more direct way. They look at payment to suppliers, money received from customers, but eventually these two numbers should nicely match, right? Now let's look at how we deal with them, right? So before we go on with this case, let's look at the relationship here. So from time zero, okay, we have this relationship, right? Asset equal to liabilities at time zero plus owner's equity at time zero. When we decompose this asset, total asset, into cash items plus other assets, this equation still holds, right? Agree? Yeah. So when time changes to time 1, accounting equation holds, and we decompose A1 into cash at time 1 plus other assets at time 1 equal to liabilities at time 1 plus owner's equity at time 1. So from here, you should see the changes from time 0 to time 1. The changes can be presented by this equation. So that is the changes in cash from time 0 to time 1 plus changes in other assets from time 0 to time 1 should be equal to changes in liabilities plus changes in owner's equity. Do you agree? That means in order to find out the changes in cash, we need to look at all other items on balance sheet, in particular the changes in other balance sheet items. Is that clear? All right. So cash is what we want to find out the changes, okay? So when we look at the changes in other assets, we don't need this now. When we look at changes in other assets, so this one is related to operating activities, right? This one is related to operating activities. Operating activities. And what about other assets? These things here, they are related to investing activities because it involves in buying or disposal fixed assets, right? Investing activities. Changes in liabilities. changes in liabilities, these items are related to operating activities, right? Changes in liabilities, what's this related to, guys? What's this related to? Financing activities. Financing activities. Okay, so changes in other liabilities, we need to look at operating activities and financing activities. Changes in owner's equity. This is financing activities, right? Revaluation, it involves fixed asset. We categorize it under investing activities. Returned profit, what involves in it? Dividend distribution. Dividend distribution, we categorize it under financing. Where's my color? Financing activities. So by looking at changes of all these items that I put color in, we should figure out the changes in cash. In particular, we should figure out the changes in cash by different business activities, right? So owner's equity, let me just finish here. We need to look at financing and investing, right? So to prepare the direct method, we need to categorize the cash flow from 3 perspectives. Financing. Okay. So to look at operating activities, we need to look at changes in other assets and changes in liabilities, right? To look at investing activities, we need to look at changes in other assets. In particular, this is non-current assets, right? Investing and changes in owner's equity. This is the reserve item. We look at revaluation, right? For financing activity, we need to look at changes in liabilities and changes in owner's equity. So in particular, owner's contribution and dividend distribution, that is returned earnings. So the cash generated by operating activities, okay, the net cash generated by operating activities plus the net cash generated by investing activities plus cash generated by financing activities should be equal to the net, should be equal to the changes in cash from 2013 to 2014. Okay. Now let's look at these items one after another. All right. So to look at cash received from customers, we need to look at accounts receivables. That is related to our customers. Do you agree? What else we have related to customers? These highlighted in yellow. What else? What accounts related to what else related to customers? Unearned revenue, right? So we need to take care of these two first. And what else? Of course, revenue related to it. Okay. Where do we get revenue number? Where do we get revenue number? Income statement. Okay. It's here, income income statement. Okay, so how are we going to deal with it? How are we going to deal with it? Remember, last week we talked about how revenue, well, from this very simple example on Friday. So to realize revenue, we increase our cash position, right? And accounts receivable. If we didn't collect cash, we record it under accounts receivable. Now, when unearned revenue involved, so how do you record the increase in revenue when unearned revenue involved? You debit unearned revenue and credit revenue. That is how you increase your revenue, right? So in this case, because we have unearned revenue involved, the other way to increase revenue is a decrease in unearned revenue. Is that clear? So cash received from customer should be equal to revenue minus the increase in accounts receivable minus the decrease in unearned revenue, or plus the decrease in accounts receivable plus the increase in unearned revenue, right? So linked to our case, do we have an increase or decrease in accounts receivable? First, we substitute revenue into this equation. This is our revenue, right? Then we look at the changes in accounts receivable. Do we have an increase? Yes, we do, right? The increase of this amount. The increase is from 2013 to 2014, okay? What happened to our unearned revenue? Decrease $500. That is equal to, right? Okay. Okay, so that's the cash received from customer. Now, next we need to look at payment to suppliers, and bear in mind these suppliers refer to all suppliers apart from employees and interest or income tax paid. Okay, so we do not take into account of these three parties. We look at what suppliers we have here. Okay. So expenses related to suppliers, and we understand this is excluding tax, employee payment, salaries or interest, and also loss on sale, because that's not related to suppliers. Okay. So these expense, how do we settle these expense? How do we settle the expense? When expense is incurred, how are you going to deal with it? You debit expense, and what do you credit? Payables. Or you deal with cash. right? What else? When expenses happened. What about your prepayment? If you have prepaid rent, when expense incurred, you debit, for example, rent expense, credit prepaid rent, right? So that involves reduction in your prepayment. All right, now let's look at the expenses related to suppliers. All right, where do we find the expenses? Income statement, right? Cleaning and polishing floor, electricity, rent. Okay, so this one, they are related to suppliers. Okay, so the cash we want to get, the changes in cash or changes the cash paid to suppliers is equal to the expenses minus increase in accounts payable minus decrease in prepayments. And the expense we have here is the cleaning expenses plus electricity plus rent expense. Okay, that's all the expenses. What about our accounts payable? Accounts payable, yeah, we're dealing with here. Do we have an increase or decrease? We have an increase, so we need to minus this increase. Prepaid rent, a decrease of $5,000. All right, a decrease of $5,000, and that is equal to an outflow. This is an outflow paid to suppliers. Okay. Okay. Now, next one, we look at payment to employees. Okay. Payment to employees, we're still looking at operating activities. So we're still looking at the yellow zone, okay, the yellow zone. Now we look at wages payable here now. Okay. So wages expense, there are two ways to settle wages expense. You pay out cash or you record it under wages payable. Do you agree? So cash paid to employees should be equal to total wages expense. Wages expense can be found again in income statement. Okay. Wages payable, changes in wages payable, increase or decrease. We have an increase of $2,300. So this is an outflow. This, okay, so that equals wages expense minus increase in wages payable, or plus the decrease in wages payable. And also for this case, this increase we minus it. If it's a decrease, we add it. Okay. If it's an increase in prepayment, we add it. All right. Okay, so that's wages, that's cash outflow to employees. Interest paid, well, we don't have any payables stuff here, so we just look at income statement. Interest expense, 560, that's the outflow. Just plug in the number to the cash flow statement. 560. Income tax paid. Income tax paid. We have income tax payable here. Okay, we're going to deal with income tax expense. Right? So income tax expense is settled by cash, or you record it under tax payables. Okay. So what's the cash paid to tax authority? That's total tax expense minus the increase in tax payables, or plus decrease in tax payables. Okay. So tax expense. Where do we find tax expense? Where do we find expense? Income statement. Okay. The changes in the payable again is on balance sheet, and we have an increase of 2,600. Is that? So far, we've already taken care of all the operating activities. Okay, so this is an outflow of 11,100, right? Let's sum it up. Okay, and you see that this number is actually nicely match the reconciliation number. See that? Okay. So that's operating activities. Now we look at investing activities. So the first thing we look at is, well, let's look at the furniture. Let's look at the furniture because it's disposed. It's no longer existing. Sales of furniture. Okay, so we have original costs of the furniture, okay, minus all the accumulated depreciation, okay, so that's the cash you should have collected from the sales of furniture. However, you made a loss, right? You made a loss, and so this is actually the cash you collect from the sales. So this is the carrying amount. This is the carrying amount you should have collected from the sales of the furniture, but you make a loss. Okay. In this case, if it's not the case, if it's not the loss, if it's a gain, you should add gain. Okay. So what's the original cost of the furniture? 10,000. Accumulated depreciation, 7,000. 10,000 minus 7,000. Lots on sale, 2,000, right here. Lots on sale, 2,000. Okay. You receive the cash of $1,000 from the sale of the furniture. It's a positive number, 1,000. Okay. Purchase of sound equipment. Okay. We have the original cost of equipment. So when we have this original, we have this equipment, we debit equipment of this amount and cash, right? But also when we improve that, this is the journal entry. When we make any improvement to this equipment, okay, we have the original value, and when we make improvement, we debit equipment of this amount and credit cash, and this is the cash outflow we're going to calculate to improve this fixed asset. Okay. So when we have revaluation, we debit equipment. In this case, how much is the revaluation? Guys, how much is the revaluation? 1,500. And a credit revaluation. Okay. 1,500. Okay. What's the original value of this? What's the original value, guys? What's the original value? 12,600. That's the original value, and that's the cumulative depreciation, right? However, we don't use the cumulative depreciation in this case because that one does not affect the sound equipment value. Okay. So the calculation is the original value plus revaluation, okay, plus cash kicked in, outflow to build it up, and then we get the